Ken Fisher, he's the guy behind certainly one of the largest independent fee-only investment advising firms on the planet. Also has a great read of humanity besides just markets. Ken, kind enough to join us right now. Good to see you, sir.
Thank you for having me on as always, Neil, and it's good to see you back from being away.
Yeah, thank you. Let's talk first, Ken, about, I was looking at your 13F filing, your portfolio value, and from the first quarter, it decreased from about 179 billion to 165 billion. Not that bad. And you were still hanging on to a lot of these big technology names that continue to get clobbered. Have you sold any positions since?
Not of materiality. In this market, what I think is happening, not every day, but most of the time, when you have a big down day, tech goes down more than the market. When you have a big up day, yesterday aside, tech goes up more than the market. Once we get to the bottom, whenever that is, I think tech will bounce, growth will bounce. And in a market like this, I think, I can be wrong, of course, I think what goes down most in the downside will end up going up when it reverses and we move on to the next phase.
What do you tell investors, though, who were enjoying that run-up when the FANG stocks were just soaring and now just want to lock in whatever they can because it's slicing away fast and furious?
Well, mind you, first, people need to get in their bones the notion that stocks are volatile in any time period, whether up or down. Some do more than the market, some do less than the market. This is a period where I think it's hard for people to understand what's going on because we're having something going on that we don't normally have, which is normally in either a correction or the early time phases of a bear market. There's one or two big, scary stories. This time I can count 7 scary stories happening all at once, and people have a hard time getting their head around all those at one time. Today, it's recession fears. We've had oil fears. We've had interest rate fears, fears of the Asian lockdowns in China and Japan, fears about the Fed causing a recession, fears just on and on, Ukraine, of course, and Russia. And trying to get your head around all these and deciding, is it a whole lot of bees stinging us that we got to run away from, or is this something that's more potentially fatal? It's just hard for people to get their hands around it. It's what I call the pessimism of disbelief, because whatever it is you say, they've got yes buts for.
You know, but we're not at that capitulation stage. And I follow you on Twitter very closely. You had recently written, don't let the great humiliator scare you from the coming rebound. So obviously you see a rebound, but when is it coming?
I don't really know, and I said that in that piece.
Right.
And the fact of the matter is, anybody that thinks they can tell you what the market's going to do in the next 3 weeks is a fool. And you know, there's a lot of people that'll tell you, and as I said in that same piece, the only people that can predict that are people that are 100% confident and overly confident and foolish. The fact is, I don't know the answer to that, and what I do believe is that normally a bear market in its early months, 2020 aside, moves much slower than this. It's more gentle. The total bear market typically moves at about 2% a month. This one has moved like a correction, 4% a month. It reminds me a lot of actually 2011, where the market behaved a lot like it's behaving now, flirted for a good long time with bear market territory, got below down 20%, but couldn't stay there, but kept trying. And then finally, after a full 6 months, did a fast bounce up and moved on to new highs. I don't think we're going to see recession. I don't think we're going to see a terrible world. I think we're going to see a world that's slow growth. You take today, I think it's tremendously optimistic that people are so concerned about PMIs that came out around the world a little lower than what they thought they would be. PMIs aren't supposed to be month-to-month indicators with precision. If they're over 50, it's supposed to indicate growth. If they're under 50, it's supposed to not. The fact of the matter is,
you're talking about purchasing managers' data.
Yeah.
And globally, it's telling a similar story. What do you make of that?
it is telling a story of growth. I don't think people should extrapolate a month's numbers from one set of positives above 50 to a slightly lower set of positives that are below what they were expecting as any great significance. That they are, it seems to me, is again a reflection of the pessimism of disbelief. That whatever you see that's good, they've got 5 bads for, and they're focused on those. You take the concern about Snap. I mean, Snap is a little company. It's a little company that basically got a very specialty focus. Reading too much into that, reading a little into it's one thing. Reading a lot into it, that's a pessimism of disbelief.
That's interesting. You know, we are now, I think, as of today, 98 trading days from the S&P peak. There are all sorts of ways you can look at that, whether this is getting long in the tooth or not enough long in the tooth. Where are you on this as far as where the market, again, you don't forecast these things, and I respect that and see that, but a lot of technicians follow this and the significance of this. What do you think?
I think your prior point, Neil, is 100% correct one, that we haven't seen the full capitulation that we would need to see the market start going up big time. But the fact of the matter is, after a period like this of steep decline for a long period of time, you can get that capitulation really fast, and it doesn't actually have to take the market down a whole lot from there. The difference between being down 18% and being down 22% will be heralded as a bear market, but it would be a distinction without a real significance. The fact is, it's 4%. And you know, for markets, a 4% is a weak week. The reality of this is we got too much being read into myopic functions. You take the history going back to 2011, rising interest rates. I mean, you remember that was when we had the pigs, we had the Occupy Wall Street movement. We had so much sense that we were still mired in recession from 2007, 8, 9, and that the Fed couldn't do anything about it. And I'm not a big Fed fan, and you know that.
Right.
But the fact of the matter is, you get to where all these things build up and you can't handle it emotionally. That's actually bullish. I think we could get to the capitulation pretty quickly without too much downside. I might be wrong. If I am wrong, what I know is the back part of bear markets is fast. It's steep, it's scary, but it's fast and over, and they then bottom and come up as fast as they go down. It's really the beginning of bear markets that take a long time. So if it's a bear market, we're pretty far along because we've been down so much. If it's a correction, it's getting long in the tooth, and we ought to get to that capitulation and get it over with. The important thing to see is you look out 6 months, 12 months, 24 months, you ought to see higher prices.
You know, in this environment, though, you mentioned the Federal Reserve, and I know you've been a noted critic here, but we always seem to sort of obsess, really, of what the Fed is thinking. And I guess maybe I'm doing that right now in posing this question. A number of district presidents and FOMC members are on the wires over the last couple of days, hinting that, in the case of one, that maybe the Fed pauses on rate hikes come September. Still another says by 2024, we'll start seeing interest rates being cut, which triggered talk of you only cut when you got a slowdown or a recession. So people are getting frantic all over again. What do you make of this?
You only cut when you have a slowdown or a recession. What about if the inflation problem seems to go away, because the real cause of the inflation problem from its beginning is as much or more supply chain issues as is anything that's actually monetary.
So that's not a death knell warning to you. That would be actually a constructive indicator.
So. Let me go a different direction, however, with a positive that people don't see. Earlier, we had a lot of concern about the 2-year, 10-year interest rate spread. And when I've been on your show before, I've pointed out that that's an unimportant spread. The important spread is the 30-year 90 days against the 10-year, which is the one that's actually used in the leading economic indicator series, because banks borrow at short rates, lend at long rates, and that spread's important. This year, and people don't get this, that spread's actually widened. It's widened. People don't get that. Oil output's actually up. Why? Prices are high. Prices have been stable for 2 months. If you look at gold, it's down over the last 2 months. People focus on these one things, but they can't quite see the other part. And I think that's actually, again, a reflection of the pessimism of disbelief. It's actually a function that's bullish. Are we not necessarily at the bottom? Right, I accept that totally. I don't know where that bottom exactly is, but it can come really fast.
Washington wants to intervene when things get scary. Besides the Federal Reserve, there's growing pressure on President Biden to do something about these gas prices. Now talk of maybe opening up a strategic reserve for diesel fuel. I didn't even know we had such a thing. But that the pressure to do something on the part of Washington, what do you think of that?
Well, you know, as you can see, I'm in Washington, D.C. right now. I've been talking to people, and, you know, my concern always is that they do something because, well, usually what they do is something stupid. But the reality is, well, they're very good at it. They're skilled. They have a lot of experience at that. But the fact of the matter is, right now, in this year, is not a lot they can do because we're moving into election cycle really fast, and the legislative world is going to move away from that. Biden can do some things with executive order. He can, you know, he can free up some oil reserves if he wants. That's not going to have a huge impact.
So when I hear talk that the administration is considering dropping the tariffs that President Trump imposed on China to deal with this, what do you think of that?
Well, think about what happened when President Trump imposed the tariffs. You remember at the time, everybody thought that would be just terrible. You recall that? Just terrible. It would decimate the economy. That was what Davos-type people would say. We got Davos going on. You know, when I hear Davos people saying bad things, I think that's good too. But the fact of the matter is, particularly when they all agree, but the fact of the matter is that when I think about this, I don't really see how, I don't see a lot of there. I mean, the reality is the economy, you take the concern that we had, and we still have. I heard somebody on your show while you were away talking about concern of recession. First quarter GDP was negative, second quarter going to be negative, maybe, and maybe I'm wrong. But the fact of the matter is, if you take out the inventory buildup in the fourth quarter and the takedown of that in the first quarter, otherwise GDP in the first quarter was positive, and people don't dissect that. The fact is, around the world's got places that are stronger and weaker, and you got a lot of problems right now in Asia. But mostly there's moderate growth. We just have slower growth than we had last year, which was a bounce back from the pandemic problems. And the reality is we have all this fear that only looks at the negative side. I think that's bullish.
Ken, finally, this is more a psychology type question for you. But when you look at the markets and people get nervous, and a lot of people want to cash out right now, we're not maybe at that capitulation stage. But I understand that it always comes back to longer term, the market is your friend. When I was a much younger person, that was great. But longer term now to me is lunch on Monday. And I'm wondering how you advise people of various age groups in a market like this.
Yeah, I've been at this 50 years. I'm a septuagenarian. The fact of the matter is most people that are older are going to live a lot longer than they think they are. They're going to have bull and bear markets. Not everyone. If you drop dead tomorrow, it doesn't really matter much. And I mean, really, it doesn't matter much. If you drop dead tomorrow, I'd focus on something else. And no, really. And when you think about having 10, 20, 30 years to live, if you're, let's say, 60, 65, 70, you got a long time ahead. You're still going to see a lot of bull and bear markets. And the important thing to remember is 1, 2, 3 years out, prices are going to be higher than they are now. This notion that we see every time, which is widely circulating now about a dead decade ahead, there are no dead decades ahead. There's no actual dead decades in history other than, you know, the dead decade period of the Great Depression. But
you kind of had not a dead decade, but a going nowhere fast decade between 2000 to 2010, right?
Yeah, but, you know, you can just roll that forward. You had to go right off the peak there,
no,
right?
You're right.
And if you didn't go right off the peak, that's not true. It's like, again, that's that pessimism of disbelief looking for a yeah, but. And in reality, if you just kind of slice through the middle of that, you had an okay decade. And I mean, if you just slice through the middle of that period, the fact is most people didn't buy in the day at the top. And if they did, well, you know, then they were the last greater fool in the market, and I can see that. But for the most part, if you have a need for good returns, 10, 20 years, you're going to see higher prices. In predicting 10, 20 years from now is a fool's game also, but in terms of any precision. But this notion that somehow it's different, it's first and it's worst, that comes up every time. First and worst fears come up every time, and they forget about after a decline like this, 1, 2, 3, 4, 5-year returns tend to be overwhelmingly positive.
Yeah, we get so obsessed in the moment. But the takeaway line from this enjoyable interview has been, if you drop dead tomorrow, it really doesn't matter.
And myopic is misery. Myopic is misery.
You're right. You're right. Let's hope we don't die tomorrow. Ken Fisher, it's always a pleasure and an honor. Thank you very, very much.
Thanks for having me on. It's an honor for me.
All right. We're down about 300 points right now. But again, that is in the moment.